The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone. My name is Jason Collins, and I am with URL Insurance Group. I'm an agent support specialist here at URL, specializing in single premium life products. First off, I'd like to thank everyone for taking the time out of your busy schedule to be with us today. Those of you that are currently doing business with URL, I'd like to personally thank you. We understand that you have many options as to where you place your business. That's why we appreciate you working with URL, and we'll promise to continue our dedication to your success. Some of you are new to the URL family. I'd like to welcome you. URL is a full-service national broker. We provide agents complete support in all of our lines. URL provides single premium life, fixed and indexed annuities, traditional life products, as well as individual and group health products. We also have a senior division that offers MedSup and MedAdvantage products. So please, after the webinar, take a moment to tour our website at www.urlinsgroup.com and discover if there are any additional avenues for URL to assist you with your success. Again, that website is www.urlinsgroup.com. Now, I'm extremely excited to be part of presenting this great program for you today. Single premium life has been growing in popularity the past few years. People, and more specifically baby boomers, are realizing that they have cash value in old whole life policies that they don't want to continue to pay into. They have money that is set aside and earmarked for the next generation, making little or no interest in seeding their savings accounts, or have real concerns about their future in regards to long-term care should they need it. And that's specifically where this product comes in. Today we're going to discuss a product that will help your clients with these concerns. I'm proud to introduce Jon Thomas with Nationwide Insurance. Jon is Nationwide's virtual wholesaler for LTC sales. He's here to review Nationwide's CareMatters single premium life product and to discuss how it will benefit your clients. Now, before I turn it over to Jon, I'd like to mention, should you have any questions during the broadcast, there's a question box on the right side of your screen that you can type them in, and we'll answer at the end of the program. So without further ado, I'd like to turn the program over to Jon.
Thank you, Jason. Really appreciate the introduction, and I'm excited to be with you all this morning and talk a little bit about Nationwide's long-term care solution, CareMatters. And Jason, really appreciate laying the groundwork for our conversation here, and you're absolutely right. There's a huge opportunity to help really Americans prepare for what I like to call the second phase of retirement. You know, a lot of the retirement planning we do is focused in and around phase one of retirement. Yes.
Jon, I hate to interrupt. Did you show your screen yet? I just want to make sure that you...
I do have my my screen showing, I believe. Bear with me just a moment. Did you pass the share over to me?
Are you under Jeff?
I'm under, I may be under Jeff. Yes. Here we are. Fantastic.
All right. Sorry, everybody.
All right. Can you see me there, Jason?
Yep, we got you.
All right. Fantastic. Yeah, so, you know, it really is a opportunity to plan for this next phase of retirement. And as I was saying, you really focus in the retirement planning conversation with clients on that first phase of retirement. And that's what people mostly think of. They think of accumulating assets to experience retirement and really the fun years of retirement, right? Spending our money, kicking back, going fishing, playing golf, all those things we love to do, right? But what we often don't think of is what happens when we lose mobility, right? When we need a little bit of care, we need a little bit of help. Are we prepared for that next phase, that care or elder care phase of life? And that's what we'll really talk about here in a fantastic solution to address that need. And as Jason mentioned, there is a huge opportunity when we have folks that have accumulated some money inside of whole life contracts, or maybe some annuities that are not necessary for income. And we have this money that we've accumulated bits here and there that we can reposition. So not asking folks for money out of pocket, but repositioning current assets and leveraging them in a better way. So as we go through the conversation here, I'd like to take about 30 40 minutes to go through some content, and if we have questions, please type them into the chat box. I'd love to address those questions as we come to a close on the call. Again, my name is Jon Thomas. I am a long-term care wholesaler with Nationwide, and a little bit on Nationwide, you probably know our name as a property and casualty company. You may be seeing a commercial from Nationwide on our auto insurance, homeowners insurance. Maybe you've seen some of our recent Peyton Manning ads, and you've heard the jingle, Nationwide is on your side, right? Nationwide on your side, that is more than a slogan to us. It is a value statement that we have really earned. We take our claims quite seriously. We have won countless awards in our auto and property and casualty business on our claims service, but it's something that we hold dear is that we live to deliver on our claims. And that experience we have in the property and casualty world, we are taking to the long-term care world. We want to be the best in the business in delivering on our claims. When someone is, in need of care, especially in the case where maybe they're losing some of their mental faculties, right? The experience and the care they receive is absolutely crucial. So we want to be easy to do business with, and we also want to deliver and be the best at delivering on those claims. From a company perspective, you may know that Nationwide is a mutual company, so we're not publicly owned, but we are owned by our policyholders. And so that gives us an opportunity to make decisions in the best interest of our policy owners. We are a Fortune 100 company. Actually, as of the last quarter, we're ranked 69 on the Fortune 100 list, to give you an idea of the size of Nationwide. Now, a little bit of background on long-term care. I know many of you are familiar with the long-term care industry and where the opportunity is. But from our perspective, as a property and casualty business, we talk a lot about risk pools. And what we know about our clients is they don't ultimately identify with risk pools, right? You may have heard the statistic that 70% of folks that live beyond the age of 65 will need some sort of long-term care, right? But do you tell that to somebody? You tell that to me, for example, and I say, oh, that's great. I'm in that 30%. I make it to the gym one time a year. I'm better and more in shape than all those other people. I'll be in the 30%, right? And that's how most of us think. We don't identify with risk pools. But the truth of the matter is, for each of us, you either have a 0 or 100% chance of needing to pay for some sort of care. It's either going to happen or it's not. And so what is the risk to us as individuals of being unprepared? What is the risk to our individual portfolio, right? The risk could be huge. Depending on our retirement portfolio and what we have saved in assets, there's a significant risk there. And so we cover long-term care costs in a variety of ways. First, through lifestyle. And lifestyle is traditionally what has been the case, where we care for one another through family or friends or a neighborhood network, right, where family members and loved ones care for one another as they need it. The other is income. Right? We assume that we have significant retirement assets set aside to provide income that will pay for some sort of care as we need it. And this third we'll talk about is insurance, using insurance to leverage our current assets and create a benefit. Now there's a statistic I want to point out here, the second bullet point you'll see on the screen, that the average unpaid caregiver is a middle-aged woman who works or did work full-time but loses a little over $500,000 in her lifetime in lost wages and benefits. This is a huge burden on families. It's something that one of the things that spurred us to get into the market and provide the type of benefit that we do is because we know that a majority of care is being provided by family members. And you'll often see that the common scenario is that parents, their eldest daughter will move back into the home. If she's out of state, she'll move back into the state and move close to her family to be able to provide care for her parents. That is the most common scenario, and you see it is at a loss to her. She's losing income by doing so, and so that is something that's significant to be aware of when we look at family structure. And also in terms of thinking of clients for retirement portfolio, retirement or assets don't pay for care, right? Income pays for care. And that's a differentiation we make because we understand that assets are set aside to create this income. And when folks need to pay for care, they don't necessarily change their lifestyle. They still expect to have a certain lifestyle, right? And that income is providing that lifestyle. And so do they have the significant assets to create or maintain their lifestyle and also pay for care? That is a major question that needs to be addressed. And in many cases, it's not. You know, they have enough income to maintain their lifestyle, to pay whatever they need to maintain that lifestyle, but care would significantly affect their lifestyle. And so that needs to be evaluated. We also know that those assets oftentimes are earmarked to create an inheritance. And so if we have three goals: income for lifestyle, inheritance, and also paying for care, one of those things often gets lost should long-term care come into play. Now, you probably are aware of a couple of different insurance programs that have been available over the last few years. Traditional long-term care insurance was the originally called nursing home insurance. It's been around for several decades, and you're probably familiar with it to some degree. Now, it has changed quite a bit over the last few decades, and people no longer think of it solely as nursing home insurance. But what we do know is that the changes in the market have caused a traditional long-term care insurance to be a little less attractive. And some of the reasons for that, there are not premium guarantees in many cases, and it only pays for long-term care if it's needed. So there is this sense that, well, if I never need the benefit, I lose out on what I've been paying, right? Now, that being said, it is the most customizable solution. About 15, 20 years ago, we started designing long-term care on insurance chassis. And utilizing life insurance as a chassis for long-term care allows us to put in premium guarantees. So we can use the actuary experience of a life insurance solution and provide premium guarantees. And the first of those was long-term care riders on life insurance, which we can take a life insurance solution, someone that needs life insurance, and tack on an acceleration of that death benefit should that person need long-term care. And then the third, linked benefit. Linked benefit contracts have also been around about 15 years, which is a bigger long-term care benefit, a smaller death benefit, but it is designed on a life insurance chassis, and so it does maintain premium guarantees, which is important. CareMatters is a linked benefit solution, and it is also known as an asset repositioning vehicle, one that is viewed as an investment or an alternative investment and not necessarily a premium or expenditure. And we'll talk a little bit more about how we can reposition assets in this sort of solution. But many of them do or require a short pay, maybe a single or one-time payment, maybe 5 or even 10 years to fund the solution. Now, you'll see in this infographic, this gives you a little idea of the structure of the product. And we'll take an example of a 55-year-old female. Let's say this female just recently retired from public service. She was a county employee, and she has a pretty nice pension, so she's set from an income standpoint. This pension is going to provide her the income that she needs, but she also got a lump sum payout. Maybe she had some accrued time that they paid out, and she got a couple $100,000 upon retirement. So she is set from an income standpoint, but does not necessarily have other significant assets. And so if she were to ever need care or significant care, she would not necessarily have enough income to pay for that care. And so we do want to look at an insurance solution to cover her need. And we're going to take, let's say, $100,000, a portion of that lump sum payout that she received. We can take that $100,000 and we're going to reposition it in this CareMatters solution. And this example shows a 6-year long-term care benefit. And it does create a couple of buckets. You'll see that first bucket is our death benefit. So this is what we call our death benefit that really addresses the use it or lose it concern that has existed with traditional long-term care insurance. So if she were to pass away and never need care, then we're guaranteeing at least you'll get $180,000 in death benefit, or her beneficiaries will receive it. So there is leverage on her investment that provides a payout for her beneficiaries. So 100 creates $180,000 of death benefit. Now there is more that's available as long-term care, what we call the extension of benefit rider. And you'll see in this example, $361,000 almost is available as long-term care payout only. This equates to $7,517 on a monthly basis. If she were to utilize the entire policy, a total of $541,000 is available in LTC benefits. And the way this would work, if she needed care, she'd file a claim. Once that claim is filed, we begin making these long-term care payments of $7,500 a month. As we pay out $7,500 a month, she burns through this initial benefit pool. And once she's utilized $180,000, this death benefit is gone. It's exhausted. And we move into this second benefit that's available only as long-term care. Now, we do guarantee at least a 20% death benefit or residual death benefit. So if she does utilize this $180,000 of initial benefit and passes away at any point after this initial benefit is used, we will pay the beneficiaries at least $36,000 in this case. So that is significant. It's something that Nationwide is unique in the linked benefit marketplace. We do believe that for folks that have a catastrophic long-term care need, and when I say catastrophic, you can think examples of folks with dementia or Alzheimer's where they may be in a care situation for 6, 7, 8, 9, 10 years, right? And that it comes with that a significant cost. And so if that is the case for an individual, they're more than likely going to utilize their entire insurance benefit. If they use their entire insurance benefit, they're also going to utilize a lot of their personal assets. And maybe that family is left with no assets. Maybe their family is left in debt, right? And so having a strong residual death benefit that can pay for final expenses is really beneficial for those folks. So this really is an attached final expense policy on this long-term care benefit. So that can be huge. Across the market, Nationwide offers 20%. Some of the other linked benefit carriers offer somewhere in the ballpark of 5%. So it is significantly more than other carriers in this marketplace. Now, some of the flagship features of the product, some other things that make it different. It is a cash indemnity benefit. And we use the term cash because it ultimately or truly is a cash benefit. We're going to pay that benefit without restriction. So you saw in that last example, the monthly benefit was $75.17. In that example, once they qualify, the insured qualifies, we're going to start making that $7,500 payment on a monthly basis, regardless of how they're using the benefit. That is unique to Nationwide. We are the only linked benefit indemnity product. Other product solutions that you might be familiar with are reimbursement. And reimbursement solutions cover your cost, but they do require proof of loss. And proof of loss simply means that as you incur expenses, whether it's a nurse coming to the home and billing you a certain amount, whether it's assisted living or a nursing home, you're getting bills and invoices. Those bills and invoices are then submitted to the insurance carrier, and they approve those bills or invoices based on them being qualified services. And then once those qualified services are approved, you then get reimbursed or a check for whatever your loss is deemed to be. This is much different in that we are sending a cash benefit, and it really can be viewed as income to use towards your LTC costs. And so when you qualify with Nationwide, you file a claim, you're going to get this income that starts to pay you on a monthly basis that you can use however you like. You'll see this fourth benefit here, informal caregivers. This is also unique because we do pay cash and we're not approving qualified long-term care expenses. Then we allow, and that income would allow you to pay family members or friends. In that second slide I showed, we talked about a scenario where family members care for one another and a daughter loses her income because she takes time away from her job to care for her parents, right? This would allow you to pay your daughter some income to provide care if that's what the family wants, or pay friends or neighbors or some other informal caregiving arrangement. This is typically not available with reimbursement solutions, as they only approve qualified, meaning paid, caregiver services. And so that is unique with this solution. The optional benefit banking you see in the third bullet point, this is a supplemental account that Nationwide offers. It's not mandatory. It's something additional we offer through the Nationwide Bank, that because you're receiving an income on a monthly basis, that income might be more than you need. And so you can save some of the excess in your personal checking or savings account, but you can also save it with Nationwide in a Nationwide money market. You can kind of keep it out of sight, out of mind if you have concerns of other family members maybe dipping into your personal checking or savings account, or maybe you're just concerned about spending it frivolously and you'd like to keep it out of sight, out of mind. You could do so with Nationwide. Along with those features, we do offer a return of premium. The return of premium is simply a return of the premium should you cancel the contract, and you do get the full 100% return after a 5-year period. So you'll see here a 5-year vesting schedule. Year 1, 85%, and that increases by 3% each year, so that after 5 years or beginning of year 6, you cancel the contract and you get 100% of your money back. Now I'll tell you, a majority of these contracts are never canceled. Across the industry for the last decade or so, and this is pretty much held true, that less than 2% of these contracts are ever canceled. A majority of folks, when they purchase a linked benefit or long-term care solution, realize it's a good purchase and they hold on to it. This really is a benefit that helps get over some obstacles to the sale, right? And so as you're talking through and people are thinking through, or maybe having feelings of buyer's remorse, you ultimately have this cancellation feature that says, you know what, this is a alternative investment. We're moving a good chunk of money. I understand it's sizable, and that may give you some pause or some reservation, right? But it is liquid. If you were to cancel it down the road, you can get that money back. So there is that 5-year vesting, but once that's complete, you can get your full investment back. And so that really does help folks get over that initial obstacle or hurdle in making the investment. Now, along with the single pay, Nationwide also offers 5 pay, and that can be made in annual payments or monthly installments, as well as a 10-year pay. With the 5 or the 10-year pay, there's not a vesting schedule. There's a guaranteed return of premium once the final payment's been made. So for example, if we're paying $50,000 over 5 years, $10,000 a piece each year for 5 years. Once that 5 years is over, they cancel the contract, they'd get 100% of their money back. So that is the way that the 5 and the 10 pay work. A couple other opportunities with the product, because it is indemnity, and these are unique to indemnity products, they pay the owner of the policy. This can create some unique opportunities for those that are wealthy. You can structure it within an irrevocable life insurance trust. So for those folks that have significant assets, you know, a couple million, $5 to $10 million, and are concerned about estate taxes, and they use life insurance trust to mitigate some of their tax burden, their estate tax burden, this can also be placed inside of an irrevocable life insurance trust. So one of my last slides, I'll go through an example of really how this is powerful, but it is a fantastic way to create some tax arbitrage for those wealthy individuals. Again, because it is cash, we don't require any bills or receipts to collect the monthly benefits. And if you're familiar with long-term care products and benefits and the HIPAA regulation, there is a HIPAA per diem amount that allows this benefit to be tax-free up to a certain exclusion. That exclusion in 2016 was $10,200 a month, and that really says that if you receive less than $10,200 a month from a long-term care benefit, it is absolutely tax-free. If you're receiving something above that HIPAA per diem, then it's potentially taxable as income. Now, what I will tell you, if you're using that towards qualified long-term care services, if you're paying for services above that HIPAA per diem amount, then it's still tax-free. Now, if you're receiving more than that HIPAA per diem and you are pocketing it as income, well, then it's going to be looked at as additional income tax or additional income that's taxed. And so that's something to be aware of, but nationwide we will absolutely pay above that HIPAA per diem. Some products are limited by that HIPAA amount. Some other things you may not think about when looking at a long-term care benefit and what you can do with it. We really designed this product to help folks stay in their home as long as possible. And so paying you an income that you can decide to do whatever you'd like to do with it would allow you to maybe modify your home. You know, put in wood floors, modify your bathroom, your shower, your kitchen, whatever you need to allocate that money towards to stay at home as long as possible. There's other transportation costs that we don't often think of. If you're driving a caregiver out to your home to provide care, and maybe you live in a rural area or you live remotely, products typically do not pay for transportation costs for the cost for that person to drive from wherever they're located to your home, but you're often billed for those transportation costs. So that's something a reimbursement solution wouldn't normally reimburse you for. It's not part of the caregiving, but if you're getting cash income, you can pay for wherever you like. Other medical costs that arise, maybe prescription costs, things that are not part of the caregiving expense and wouldn't normally be covered, could be paid for under this product. Now, I do want to walk through an example, and I want you to keep in mind if you've looked at long-term care solutions before and you're familiar with reimbursement solutions, maybe you're talking to a client that's looked at a product that's been a reimbursement solution, there's an opportunity to revisit the long-term care insurance solution with those folks. And this example is really going to highlight the power of a cash solution. And really the power is the opportunity to get the most out of a policy and not be limited by qualified expenses. Now what you can imagine probably is that a indemnity or a cash solution is a little bit more expensive or costly than a reimbursement solution. And you are right. That from an actuary standpoint, when we're designing these products, we know that we're going to pay out a full benefit when someone qualifies. And because we're going to pay out a full benefit, and our benefit or our payout is not limited by the average cost in the industry, we have a larger risk than other solutions that are reimbursement. And so when you're looking at product solutions, a reimbursement solution may offer a little bit more in potential benefit. But at the end of the day, when we look at average costs across the industry, they're not necessarily paying out more. And so this example highlights that. And we're just going to use a 4-year claim. You know, if you're familiar with some of the statistics in the industry about claims, we know that the average claim is about 4 years. And we're going to use an easy number for average healthcare cost. We'll say this is care provided in-home at $3,000 a month over this 4-year period. If we take this claim scenario, $3,000 a month over 4 years, on the left-hand side, you see a reimbursement insurance contract might offer us $6,000 a month. Well, in this claim, if our cost is $3,000 on average over 48 months or 4 years, it would ultimately pay $144,000. On the right-hand side, you see our CareMatters contract, the cash contract, right? It offers $5,000. So from a potential benefit, there's a $1,000 difference. Reimbursement is $6,000, CareMatters at $5,000. But we're going to receive that $5,000 for the full length of the term. That's guaranteed. And over that 4 years, we'd get $225,000. Now, this is a pretty simple example, $3,000 a month. We know that, you know, no claim is going to be $3,000 a month for 4 years, right? We're using that as simple numbers for this example. But on average, we might have a claim that's $3,000 a month. And what we know about the care need and claims is that they are progressive. And so when you look at someone that it needs care, is entering that phase of needing care, it generally starts with them becoming a little bit frail, right? And once you start to become frail, you may need a little bit of help getting out of bed in the morning. You may need some help bathing, getting dressed, but a lot of the other tasks around the house that person's still able to complete. or a family member is there, spouse is there providing help with things around the house and with meals. And so early on in this process, the cost is generally pretty low. You know, we may start out with someone coming to the house that we're paying for care, you know, twice or 3 times a week, and it might be $1,000 a month, a pretty inexpensive cost. And in that scenario, that person's care need progresses over the next 3, 4, 5 years to the point where they may need more round-the-clock care. And in that scenario, we're talking $1,000 in the beginning of a claim, which might end up at $5,000 or $6,000 a month at the end of a claim. And that is typically the scenario when we look at claims and the need for elder care. And what happens with these 2 different contract types, if you have a reimbursement solution in the beginning or the first year or 2 of your claim, you're only paying out $1,000 or being reimbursed $1,500, $2,000, you're leaving a big chunk of your benefit inside the policy. And as that builds up inside the policy, it lengthens the term of your policy before you can access all of your benefit. And there's a big chance that you may never get to the point where you can access all of your benefit. We know that the majority of claims are less than 5 years. Actually, 85% of claims are less than 5 years. And so if we design a 5 or a 6 year benefit, and we haven't gotten our full benefit over the first 2 or 3 years, we've left a lot of money inside the policy that we might never access. So using that same example, I'm going to take this a step further. We have the same numbers on the left-hand side in a reimbursement contract and the indemnity on the right-hand side. And you can see how we've put this out in a different format. But if we say, hey, this person, you know, they didn't pass away after 4 years, but they went to a nursing home. They needed round-the-clock custodial care, and they were in a nursing home for a year. And for that year, the cost of the nursing home, maybe it's a semi-private room in the nursing home, was $8,000 a month. Well, if you look at your reimbursement contract, it will reimburse up to six grand. There is a shortfall of $2,000 a month. If they're receiving 6 grand and the nursing home costs 8, right? So over that year that they're in the nursing home, they're still coming out of pocket $24,000. Well, how about on the right side in our cash contract? It will pay up to $5,000 a month. The nursing home costs 8 grand for 12 months. That's $3,000 a month shortfall, or $36,000 for that final year in the nursing home. But if we were able to accelerate our entire benefit all along the way, we've been able to save some excess cash, right? We've been able to sock away $81,000 in cash benefit. And if we save that in the Nationwide Bank, or we save it in our personal savings account, we've got this $81,000 that's come out of the insurance policy, and that's more than enough to cover the $36,000 shortfall for not just 1 year, but 2 years, and still have a little bit left over, right? So being able to access your cash early when your costs are low gives you the most potential to utilize your full policy and get the most benefit out of your policy. It also gives you all the flexibility that cash can provide. One of the other things I'll mention, you know, the average claim is 4 years, but that doesn't mean that the average elder care scenario is 4 years. We do know that on average there are 2 to 3 years often of care that's provided informally. When we say informally, most often it's families providing care. And so this is 2 to 3 years of care before any sort of long-term care claim is filed. Now, with most contracts, if care is being provided informally, there's not a huge care need, but there is some care involved. You're not going to file your reimbursement contract because you know you're not going to get anything from it. You're not paying for care, and so there's no really opportunity to file and get benefit. But if you're providing care for 2 to 3 years informally, you can file your claim with Nationwide and start to get your benefit. And if you can get to your benefit early and sooner, you have a fantastic opportunity to accelerate all of your benefit, depending on how long that person lives or is on claim. Now, one other thing I'll mention, and this has to do with the claims process. I mentioned earlier in the call that Nationwide wants to be the best at delivering on claims in the long-term care space. And one of the ways we do that is by not requiring any special plan of care. So if you're familiar with long-term care regulation, it does require, when you go to file a claim against a long-term care insurance solution, three things. Requires a doctor certify that you are cognitively impaired or can't complete 2 out of 6 activities of daily living. And you know those activities of daily living, things like feeding yourself, bathing yourself, dressing yourself, continence, those activities, if you can't complete 2 of those things, or you have some sort of cognitive impairment. So those 2 things, those qualify you. And then the third thing is a plan of care that's required. And a plan of care often involves some sort of proof of loss. I mentioned a plan of care might be that a qualified caregiver comes to your house 3 times a week. With most solutions, like a reimbursement contract, you also have to start incurring costs. You have to institute this plan of care. You have to start incurring costs. That caregiver starts coming to the house, and then you get some invoices together, and you submit them with your claim, and that's when your benefit begins, and you start getting your reimbursements. With Nationwide, the plan of care can be very simple. It can state, for example, that informal care is the plan. Because we have no need for qualified caregiving, if the doctor certifies and says, you know what, the plan for this insured is that their family is going to care for them, informal care is the plan. That is sufficient for us to qualify, and we'll begin kicking out those payments. I do want to walk through one other example and talk about net cost when evaluating a couple of different product solutions. And these are solutions you may be aware of. Nationwide's CareMatters with Lincoln MoneyGuard and Pacific Life Premier Care. And we talked about some of the price difference or leverage difference with each of these products, Nationwide versus a reimbursement solution. Lincoln and Pacific Life are 2 reimbursement solutions. And you see here for an equivalent benefit, $540,000 of total LTC benefit, that Nationwide single premium is $120,000 versus Lincoln's $117,669. Now, it is a little less expensive up front, right? We're allocating or investing a little bit less. When we take into account a residual death benefit, Nationwide is 20%, Lincoln's is 5%. And you'll see the net cost at the end of the day, or the net cost to their estate, is $84,000 versus $108,000 with Lincoln. Now, full disclosure, Lincoln does offer a variety of options. This is their 100% return of premium option, which is similar to Nationwide, so this is an apples-to-apples comparison. They do also offer an 80% return of premium option, that no matter when you cancel, you get 80% of your money back. That option is a little less expensive, and so that 80% return of premium option might require a single premium of $106, let's say, versus $117. And so in that case, your net cost might be closer. It might be about the same. Now, one of the things I would say, and we talked about this a little bit early on, when you have someone that has a couple $100,000 of assets sitting inside their bank account, right, and you ask them what they're going to do with that money, more than likely they're saving it in case of an emergency, right? And one of those emergencies often is health care costs or long-term care costs. That is a big fear that most people have in that later half of retirement. The second thing they're going to do with that money is pass it along to their kids or grandkids, right? They're going to pass it down to their heirs. Hey, if I don't ever need this money, I'd love to pass it down to my kids or my grandkids. And so whether they know it or not, they do have their estate in mind. And so they're concerned about the net cost of their estate. Well, if their estate gets a 20% cost recovery from the Nationwide product, then it is a less expensive product to their estate and therefore to their heirs. And so when you're looking at these different solutions, you can think about the Nationwide solution being a cheaper or less expensive cost to their estate and to their heirs, or what they're taking out of those assets that they pass. They plan to pass along because they do get 20% of that money back. I want to walk through with you one last example. I mentioned I would talk about those wealthy individuals and the opportunity for a little bit of tax planning and tax arbitrage. When you have those wealthy individuals that have the concern that they might pay estate taxes. They're in that 5 million range as a single person, or 10 million as a married couple, and they're looking at solutions to mitigate some of this estate tax. The ILIT really is the go-to solution, and most of these folks will have some life insurance, right, that they've put aside inside of an irrevocable life insurance trust to mitigate some of their tax burden and move some money out of their taxable estate. But we can also use a long-term care product to help with that tax mitigation. Now, I call this example the cost of being lucky. And really, when we say lucky, lucky is the ideal scenario. Lucky means you live to 90, 95, and then you pass away in your sleep, and you never experience that loss of mobility and that need for care, right? That is truly the ideal scenario for many of us, right? Well, if we have a wealthy person that's lucky, and let's say they set aside $1 million liquid, they have it sitting in their account to pay for some of those expenses, those healthcare costs, long-term care if they need it, and then they pass away in their sleep, right? Well, that $1 million that was sitting in the account liquid is then subject to estate taxes, and at the current rate of 40% on a federal estate tax, and that doesn't include state estate taxes, right? But the 40% federal, they're going to pay $400,000 out of their estate in estate taxes. So that cost of being lucky, really, in this example, is $400,000. Well, let's say we take some of that $400,000 that we're going to have to pay to the government anyway in estate taxes, and reposition it inside of an irrevocable life insurance trust, funding a CareMatters solution. Well, what's beautiful about this example is no matter what happens, you do gain some leverage, some tax arbitrage. We put this CareMatters contract inside of the trust. If this person passes away and never needs care, then the death benefit does pay the trust tax-free. So whatever money we've taken to fund the policy is moved out of their taxable estate, and then it was leveraged maybe 1.5, 2 times in tax-free death benefit that goes to their trust. If they do need care, as they file a claim and start to receive income, that income is paid tax-free to their trust. And so their trust is earning tax-free income outside of their estate. And then they can pay for whatever care they need out of their taxable estate. So they can pay it out of their bank account, pay for care, and this is qualified or qualified health care, which is going to reduce their estate, right? And so they're reducing their estate with qualified expenditures as they're increasing the size of their trust on a tax-free nature. And so that trust earns this tax-free income, and their estate is dwindling. Their taxable estate is dwindling as they're paying for care. And if they receive their entire benefit out of the CareMatters policy, they might leverage their investment 4, 5, 6 times, depending on what age they purchase the contract. So that can be a fantastic opportunity to really create some tax leverage. So we at Nationwide would say when you're evaluating an opportunity to help your clients prepare for this phase 2 of retirement or long-term care, don't just evaluate products and how the benefit looks, but evaluate how the benefits are paid. Evaluate the claim. What would a claim look like for this client, and how would it pay out? So I do want to pause here and open it up for any questions. I don't know if any came across, Jason.
John, I don't see any here. Yeah, there's no questions coming in. If there are any questions, you can certainly reach me. Everybody that is on the line, I'll surely follow up with everybody also. So, when I do follow up, you guys can ask the questions then. So, John, I just thank you very much for giving us the great and informative presentation. Thanks everybody for joining the presentation today. If you do have the questions, please feel free to give us a call here at URL. For any of the single premium needs, any annuity needs, should it be brochures, illustrations, or any of the answers to the questions, like I said, our toll-free number is 1-800-926-8875. My name is Jason Collins. I'm at extension 156. And with that, I just want to thank everybody and have a wonderful holiday season. Take care.